All right, preferred stock in this lecture. Preferred stock, we're going to go through how we deal with preferred stock when we issue dividends, and then we're going to talk about how issuing preferred stock and why we would issue preferred stock in the first place, like what are the characteristics and so forth. So anyway, preferred stock. All right. First reason, man, this goes right into really the journal entries for issuing preferred stock, and maybe what I want to do is first talk about like what it is and why we would issue it first. Okay, so if I think about ownership in my business, right, my I'm always going to quantify my ownership in the business by the amount of common stock that are outstanding. So let's say that I have, we can keep it really simple. And again, I can assume that I have 100,000 shares outstanding, and it's all mine. All right. And and at the moment, I have this great idea, but I don't really have the capital to pursue it. So I need to go out and I need to raise some money so that I can like turn my idea into a living product. And let's say that I need, something in the order of $10 million. Dollars. Okay. If I issue common stock in exchange for $10 million, dollars, then I only own a very small portion of my business, right? So 100,000 out of 10 million, I can't do that in my head. Yeah, it's less than 1%, right? 100,000 divided by 10,000,000, 100,000 is literally less, something slightly less than 1%. And then these individuals, whoever they might be, would own 99%. And it's my company, right? It was my idea. It was originally my company, but since I needed capital and I issued common stock, I gave up a lot of ownership of my business, okay? So instead what I can do is I can issue preferred stock, okay? And preferred stock, they don't have a claim on the ownership of the business. And because of that, instead, they have other rights that common shareholders don't have. And so let's see. Um, yeah, they don't have a good slide, I guess, in this PowerPoint presentations. So there's only a few that we really need to think about. But preferred stock, right? Since it's not ownership stock, meaning, if we're going to distribute like excessive amounts of profit, it's not really going to go to the preferred shareholders. It's instead going to go to the common shareholders. So in exchange for giving up that, preferred stock acts a lot like debt. Okay. So there's usually a dividend percentage, right? So every period, the preferred shareholders are going to get a dividend. And the dividends are a lot like the interest payments would be if we were to borrow money from somebody. Okay, so preferred shareholders get a dividend. And the nice thing about being a preferred shareholder is if you do declare dividends and you don't have enough really to go around for everybody, the preferred shareholders, they get their dividends first. We call that liquidation rights. So if we have limited funds to pay dividends, the preferred shareholders are going to get their guaranteed dividend first. And if there's anything left over, then it'll go to the common shareholders. In addition, if shit really hit the fan and we had to shut the business down and sell all the assets, the preferred shareholders would get their capital back first before any distribution to common shareholders. So we have liquidation rights. Man, how fucking embarrassing. Liquidation rights. Don't even ask me how to spell it. Anyway, so we have dividends, liquidation rights. Sometimes there will be instances where preferred shareholders will be given an opportunity to convert their preferred stock to common stock, right? So they have conversion rights. And it could be dependent on certain things like you can, exchange your preferred shares to common shares after 5 years, or assuming that the company reaches a value of X, right? And it's not always going to be 1 to 1, but it could be like for every 10 preferred shares you have, you can exchange those for one common share, right? So again, the 10 million versus 100,000 example, the 10 million shares of preferred aren't going to equate to 10 million common shares. It could be, in fact, only 1 million common shares or even something less. So that is preferred stock. Okay. Now I think we can go back and we can look to see how we would issue preferred stock. And we're going to issue preferred stock very similar to the way that we issue common stock, right? So the market price or the sale price of the stock, um, maybe I need to move this over here. Maybe I should have always been doing that. Anyway, we are going to issue 50 shares of 100 par value preferred stock for $6,000 total. Okay. So if I'm going to receive 6,000 in cash, I'm obviously going to debit cash for 6,000. And then if I'm issuing 50 shares at $100 per share, the preferred stock at par bucket will be 5,000. And then everything else, 1,000, goes to an account that we call paid in capital in excess of par dash preferred stock. Okay. And usually it's a case that preferred stock will be listed on the balance sheet first before common stock. And that's what they're doing down in this table, right? And so again, we have the par value of preferred stock. Then we have a second bucket, which is paid in capital in excess of par related to the par value, related to the preferred stock. And then we have common stock, and it looks like we issued all of the common stock at par value because there is no additional paid in capital account for common stock. And then we have retained earnings, right? So again, assets equal liabilities plus equity, right? We have retained earnings, and then we have capital. And now we have 1, 2, 3, in this example, 3 categories of capital. And then this right here is our retained earnings. Very cool. For total stockholders' equity of 371. Okay, moving on to how we deal with the dividends associated with preferred stock. Okay. So again, preferred stock, before we get into calculating the value of the dividend that they're entitled to, there are 2 types of dividend payments to preferred shareholders. There is what we call cumulative and non-cumulative. Okay? So cumulative means that you are required to pay every year. And if you do not pay in a previous year, then in the current year, you have to make a makeup payment from the payments you've missed before, plus what you're obligated to pay this year. And so if I've missed dividend payments in the past, we refer to that as dividend in arrears, right? And it's just a complicated way of saying, hey, there's unpaid bills related to the preferred shareholder dividends that you have to make up, and you have to call it good. If it is non-cumulative, right, then we don't have to worry about if I miss a payment, then unfortunately I just or those preferred shareholders don't get that dividend, and they don't get a makeup payment. Okay. So how do I quantify? How do I quantify my dividend payments that are supposed to go to preferred shareholders? Let's give this particular slide, although already it's concerning me, but let's just see what it's saying. All right, so consider the following stockholders' equity section of the balance sheet. The board of directors declares a $5,000 dividend. Okay, in year one. And then in the second year, they declare a $42,000 dividend. Okay. So how much in year one? I'll do year one over here. Eh, There. Okay. So if I'm declaring a $5,000 dividend, what I want to know is how much is going to go to the preferreds and how much is going to go to the commons. So I guess the first thing I really need to do is figure out um, what is the amount that is supposed to go to the preferreds. And maybe if I go back to the journal entry that we talked about the par value, and unfortunately, they didn't tell us what the dividend percentage was when we issued this particular stock. So we can just go back and we can look at this. So uh, let's see what they're trying to argue. Dividend in arrears in year one. Um, Man, I really wish that they would give us a way to calculate the dividend payment to preferred shareholders. That's terrible. Usually it's the case that we will pay dividends to preferred shareholders par value times number of preferred shares times dividend percentage, right? So they're saying the par value of our preferred stock, we definitely know that. The par value was $100, okay? And we issued 50 shares. So the par value times the number of shares outstanding is 5,000. Okay. So I at least know that there is $5,000 worth of par value, and these preferred shareholders, there's going to be some dividend percentage, but doesn't look like they're giving it to us in this question. All they're really telling us is that um, the preferred shareholders are getting the 5,000 dividend payment in year one. And then in year two, right, if there is a $42,000 dividend payment made in year two, and we are dealing with cumulative, then you have to make up a, me- a man, I'm killing myself. You have to make a makeup payment, right? Your makeup payment is 4,000, right? So it seems as though what we're saying is the total dividend that is required to be paid to the preferred shareholders is 9,000. So if I only paid 5,000 in the first year, then in the second year, right? So in the second year, we then have to make the 4,000 makeup payment from the previous year, and then we pay the 9,000 that we always have to pay every year. So in the second year, we're going to pay $13,000. Okay. The total dividend is 42,000. So if I have 42,000 minus the 13 that I am obligated to pay the preferreds, everything else in the second year can go to the common shareholders, right? Which is this in the second year. Very complicated. Very, very complicated. It doesn't have to be that complicated. Okay.